Morning. I'm Giancarlo Grasso, Director of Strategy and Business Planning at AMCHAM Korea. Thank you for joining us today for part 2 of our CFO and Taxation Committee joint webinar. This webinar series, along with the one that was held on April 1st, are part of a joint webinar series between the Taxation Committee and the CFO Committee. In our last webinar, we talked about filing individual tax returns in the United States. Today, in part 2, we will focus on things to consider when filing individual tax returns in Korea. Today, we are joined by experts in the Global Employment Service who will answer questions related to recent changes that may affect you. AMCHAM's membership is engaged in around 30 active standing committees divided by industry, which meet regularly to discuss issues that affect businesses and industries as well as those business sectors. We want to thank all of our speakers as well as the CFO and Taxation Committee co-chairs for providing this valuable content today. If you have any questions during the webinar, please use the Q&A function at the bottom of your screen, and please do not use the chat function. All questions will be addressed at the end of the webinar. Now, I would like to hand it over to Hyeok, co-chair of the Taxation Committee, to introduce our speaker and moderate the session today.
Great, thanks, Giancarlo. Good morning, everyone, and I hope everyone's enjoying the beautiful weather and also staying healthy and safe. On behalf of the co-chairs of the Taxation Committee and the CFO Committee, thank you for joining us on this webinar today. As Giancarlo mentioned, my name is Henry An, and one of the roles that I have in AMCHAM is serving as a co-chair of the AMCHAM Taxation Committee. Folks, I can't tell you how excited I am about today's webinar. This represents the second part of a two-part series of webinars covering individual income taxation and reporting requirements. Some of you joined us for part 1, which was held last month, and focus on covering various US compliance related topics. Today we're going to shift gears and focus on Korean compliance obligations. And I know for a fact that there's a tremendous amount of interest on this topic, as demonstrated by the strong turnout this morning. We're so very fortunate to have a couple of highly esteemed tax experts from Deloitte Korea join us today to share their valuable insights. Let me begin by introducing Min-Soo Seo, who is a tax partner with 21 years of experience serving multinational companies on various tax matters. Min-Soo is a tax expert in global mobility and currently leads Deloitte Korea's Global Employer Services Group. And Min-Soo has a bachelor's degree from Yonsei University and a Master of Science in Accounting from the University of Texas at Dallas. Joining Min-Soo is Hyeok Kwon, who is a tax partner with 16 years of experience and specializes in providing tax and consulting services to expatriates employed by multinational organizations. And he's the tax partner in charge of global employer services at Deloitte Korea. Hyeok received his bachelor's degree from British Columbia Institute of Technology in Canada. Now, before we get started, let me just tee things up by making some quick observations about the current environment. The desire for tax transparency and ensuring fair taxation in a rapidly changing world, coupled with advances in digital technology, enabling the analysis of big data, the emergence of cryptocurrency and other virtual assets, as well, I would say, as the increased mobility of employees at organizations. Those have all contributed to the increasing complexity of tax compliance and reporting. And as the rules and regulations continue to change with the times, it can be incredibly it can be incredibly challenging to stay on top of all the different developments, even for tax professionals. The objective of today's webinar is to raise your awareness on various issues and topics that may be relevant to your own personal situation and circumstances. Moreover, given the upcoming Korean compliance and reporting deadlines, I think the timing of this webinar couldn't have been better. Okay, I know that there's a lot of great content to cover, so let's get started.
Hi, everyone. Thanks for your kind introduction, Mr. An. First of all, I would like to thank AMCHAM for inviting me to this webinar. I'm so delighted to present today and hope this session will give you insightful information regarding your Korea income tax matters. Let me briefly introduce today's topics. Okay, so I will present for first three topics as shown in this slide, including the tax implication related to FiveYear Law and how to report your income tax for equity income, such as stock option or restricted stock unit per each transaction stage. And recent tax law update for company provided housing. Excuse me. Then my colleague, Mr. Kwon, will cover the remaining part, including the changes in taxation of investment income, which is one of the hottest issues in Korea among individual investors, tax consideration on remote work, and immigration update. I guess Mr. Kwon's part may be more interesting to you, but anyway, I'll do my best not to make it burn. Okay, let's move to today's first topic. Have you heard about FiveYear Law for Korea individual income tax? FiveYear Law applies to various tax compliance for foreigners working in Korea, so it is very important to clearly understand how it does affect your Korea income tax reporting. Korean government has been granting some tax incentives to foreigners, and there are two important benefits provided to foreigners for 5 years. First one is a preferential tax rate application on employment income, which is called as a flat income tax rate. And the other one is limited taxation on foreign source income. Both incentives are granted only for 5 years, but there is a slight difference in counting such 5 years. Limited taxation on foreign source income applies when you reside in Korea not exceeding 5 years during recent 10 tax year period. During this 5-year period, the foreign source income, such as your foreign US financial income or rental income, is not subject to income tax in Korea unless it is paid in Korea or limited to Korea. I understand there are some similar process in other countries such as the UK, Japan, and China. Let's take an easy example. If you were first relocated to Korea in March 2018 and continue to reside in Korea as of now, your foreign source income is not taxed in Korea until 2022 tax year, unless it is paid in Korea or limited to Korea. So 2023 tax year will be the first year where your worldwide income is taxed in Korea in this case. FiveYear Law applies a bit differently for application about flat tax rate on employment income. In this case, 5 years is counted from your first working date in Korea. For your easy reference, if you started your employment services in Korea during 2022, you are able to elect 20.9% flat tax rate on your employment income rather than the progressive tax rate up to 2026 tax year. There is no reset allowed in counting 5 tax year, even if you use the normal progressive tax rate for a certain tax year. in the same example, if you use the normal progressive tax rate in 2022, which was more beneficial to you than a flat tax rate due to relatively small employment income in 2022. A flat tax rate can be elected only up to 2026 tax year. So please be understood that it is not 5 times, but just 5 years from the first working year. When applying a flat tax rate, benefit in kind item treated as non-taxable under progressive tax rate, such as employer portion of national health insurance premium contribution, home leave cost, or relocation cost, is taxed. So your company should be very careful to settle your annual payroll income tax when using a flat tax rate. Also, itemized deduction, personal exemption, or tax credit cannot be applied under a flat tax rate method. So every year you need to compare which method will be more beneficial to you considering your income level. Since current marginal income tax rate in Korea is almost 50, as shown in this slide, it is great incentive to foreigners having high employment income for first 5 years. According to prevailing tax law, the sunset period for application of a flat income tax rate is set by the end of 2023, which means foreigners who will be newly relocated to Korea in 2024 to work in Korea is not allowed to elect a flat income tax rate on employment income. But Korean government has been extending the sunset period again and again for past 18 years from the initial introduction of a flat income tax rate. And I hope there will be another extension next year. Let's look into additional reporting requirement related to 5-year rule. Foreigners who have resided in Korea exceeding 5 years during recent 10-year period would be subject to additional reporting requirement, depending on certain conditions from year 6. First 3 reporting requirements shown in this slide are not part of your annual income tax return, but must be separately filed by the end of June of the following year, depending on foreign asset investment circumstances. A foreign direct investment reporting is required when a taxpayer had direct foreign investment with 10% or more ownership in a foreign corporation. Foreign real estate reporting is required when a taxpayer acquired or sold foreign real estate with a price over 200 million Korean won, or had investment income arising from such foreign real estate, such as rental income, in the tax year. Foreign financial account reporting is required when total foreign financial account balance exceeds 500 million Korean won on the last day of any month in the tax year. Reportable accounts are not limited to cash bank account, but also extended to stock, bond, insurance, fund, etc., as long as they are held in the form of financial account. Underreporting or late filing may cause significant penalty. Based on our past experience, it is quite difficult to appeal or negotiate against the tax authority when relevant penalty is assessed, even if it is caused by misunderstanding of the law or delay of filing by mistake. And recently, there have been some cases where the tax authority asked foreigners to explain the reason for non-filing, non-reporting of foreign financial account after analyzing relevant information collected, such as past tax return filing record, immigration record, etc. Thus, you should be very careful when determining relevant filing obligation, considering your financial asset held on your foreign account. Unlike the US, capital gain is not combined with other income through annual income tax return filing, but separate filing of capital gain tax return is required. In case of capital gains arising from disposition of foreign asset, it is subject to tax when a taxpayer had a domicile in Korea for 5 consecutive years or more as of the date of disposal of foreign asset. It is a different 5-year rule applied to all tax residents, not a preferential treatment for foreigners. So different tax rate apply depending on type of foreign asset, and filing deadline of capital gain tax return is the end of May of the following year. Foreign tax credit can be applied if relevant tax is properly paid in the country where the asset is located. It would be somewhat confusing or complicated counting 5 years for each reporting requirement. So please always seek a tax advice from the tax expert when your situation is not simple or straightforward. Okay, let's move to next topic for tax implication on equity income. This is one of the area where many employees, including the Korean employees, seek for tax advice and relevant tax filing method. Many multinational companies in Korea recently requested us to train their employees for tax implication and compliance obligation thereon. Also, Korean tax authorities have been extending relevant tax investigation against multinational companies regarding both employer and employee tax compliance on global equity plan. But as you know, multinational companies are operating the global employee share plan as a kind of a long-term incentive, such as a stock option, ESPP, the restricted stock unit, the restricted stocks, etc. When you consider relevant tax implication on equity income, most important thing is to identify exact tax base on acquisition or sale of shares and relevant type of income to be declared. Also, you should be very careful to identify the source of income. If you have been residing in Korea for less than 5 years, or you have a stock option or restricted stock unit granted before you were relocated to Korea. There is no taxable event on grant of stock option or restricted stock unit. The stock option is taxable as an employment income at the time of exercise. Tax base is the difference between the fair market value at the time of exercise and exercise price of the shares released. Restricted stock unit is taxable, also taxable as an employment income when actual shares are released at vesting. The tax base is the fair market value at vesting of the shares released. If the stock option or restricted stock unit is granted when you had worked in other country, but exercised or vested after being relocated to Korea, relevant sourcing for employment income should be properly allocated based on working period between grant and vesting date. In these cases, the foreign source income is subject to 5-year rule, as I explained in the previous section. Dividend income arising from foreign shares held is considered as foreign source income and subject to 5-year rule. Capital gain arising from the sale of foreign share is subject to another 5-year rule, as I explained before. If it is subject to tax in Korea, relevant tax rate for foreign shares is 22%, which is flat. The tax base is the difference between sales price and fair market value at the time of exercise or vesting in case of RSU, where relevant shares were acquired through the company's employee share plan. Recently, there has been an interesting court case where a taxpayer filed a tax appeal against the Korean tax authority to mitigate the tax assessment for underpaying income taxes by treating entire earning for stock option as capital gain, not separating as employment income and exercise and capital gain as sales. He insisted that he just followed the oral guidance by the district tax officer but the court rejected his appeal since constant tax assessment by the tax authority was in line with the prevailing tax law. Based on my experience with employees working in Korea for multinational companies, many of them are not still familiar with relevant tax treatment for stock option or restricted stock unit. I hope you should always obtain a tax advice from the tax experts in the concerned area, never relying on any oral guidance from a district tax officer when you encounter a challenge in your Korea income tax matters. Reporting method for employment income related to stock option or restricted stock unit is different depending on whether relevant cost is borne by the Korean entity or not. So if it is borne by the Korean entity, it is treated same with the local payroll income and subject to monthly payroll returning tax and annual year-end payroll tax settlement process. But if it is borne by the foreign parent company, an employee has an obligation to declare such equity income on a voluntary basis through annual income tax filing, or utilizing the taxpayer association, which is a qualified tax withholding agent for offshore employment income. If it is reported to the taxpayer association in due courses, it can be combined with the other local payroll income when the year-end payroll tax settlement is done by the company. 5% tax credit is granted where progressive tax rate apply. If this equity income is timely reported through the taxpayer association, but it is not granted if a flat tax rate is applied on such equity income. Dividend income arising from foreign shares must be declared through annual income tax return, and the capital gain tax return must be separately filed by the end of May of the following year, subject to each different 5-year law for foreigners. Okay, let me briefly touch today's last topic assigned to me. The reason why I included this topic is there has been a challenge regarding the tax implication on company-provided housing related to a flat income tax rate application for foreigners. Here is the short background. Until 2020 tax year, qualified housing was not taxed by either progressive tax rate or flat tax rate, since it was excluded in the scope of employment income according to the tax law. Qualified housing means the company provided housing meeting strict condition in general, where a risk contract is made in the name of the company, rent is directly paid by the company to the renter, not the cash allowance or the cost reimbursements type. And housing is not a service to the residence or hotel type. However, the Korean government revised a relevant article in the tax law and included qualified housing in the scope of employment income, but classified it as non-taxable item to be consistent with other non-taxable benefit in kind item among employment income. Actually, there's no difference in tax due whether it is classified as tax exempt or non-taxable under progressive tax rate. But non-taxable benefit in kind item are subject to tax where a flat income tax rate is applied, as I explained before. So it would cause significant tax burden for foreign expats electing a flat tax rate on employment income due to the revision of relevant article of income tax law by the government. Not sure at the time the government intention is to collect more income taxes for foreigners, but I believe it is not. But they did not consider the relevant effect to a flat tax rate, I believe. Anyway, there were a lot of challenges and petitions by the multinational company, including the Deloitte, and interest group on this revision. So the government suspended relevant taxation on qualified housing under a flat tax rate method until the end of 2023 by inserting exception praise to the addendum of income tax law. We are not sure whether Korean government will further extend such temporary suspension next year, but we will try to suggest further extension to the government. Actually, the new government led by Mr. Yoon since yesterday, in line with the sunset period of a flat income tax rate, hopefully with support from AMCHAM, the ECCK, and other interest group. These are all I prepared for this webinar. One thing I would like to point out is today's contents only focus on Korean tax implication. But for US expat, it would be more important to consider the US and Korea tax implication together to achieve most efficient combined tax strategy, since they are required to file US tax return every year while living in Korea. Sometimes tax saving in Korea would cause additional income tax due in US, depending their effective US tax rate. So in this case, the risk management to avoid any penalty for non-compliance in Korea would be more important, I believe. Okay, thanks for hearing. And now I would like to hand over the mic to my colleague, Mr. Kwon, for more interesting topics.
So, well, okay, from in this section 4, we will take a look at more insight on changes in taxation of investment income from year 2023. Well, before I begin, I would like to mention first that the new president, Mr. Yoon, since yesterday, his administration, they are currently reviewing the relevant regulation regarding the taxation of investment income and also the virtual assets. And also I heard that they are planning to revise the law within this year. So I believe most of you have already heard about that through the media. So under this section, I will explain what the current regulation is and how the new administration is trying to revise it. So first of all, I would like to begin with introduction of a new tax regime for financial investment income. According to the Korean individual income tax law, the taxable income includes composite income, well, we call it 종합소득 in Korean, and retirement income and capital gains. And each of them are subject to tax on a unique tax calculation structure. For the starting from tax year 2023, capital gains generated from transfer of shares is now reclassified as a financial investment income, and it is subject to separate taxation. So who must file? Those residents who have such capital gains are required to file this income separately. But for capital gains from the sale of foreign shares, if residents have not stayed in Korea consecutively more than 5 years at the time of sale, the capital gains from the sale of foreign shares are not subject to taxation in Korea. So this 5-year rule, means already mentioned earlier, applies to both Korean citizens and foreign nationals who are tax residents in Korea. Well, of course, for non-tax residents, they are not required to report any capital gains from overseas. However, recently the new president, their finance minister nominee, Mr. Chu Kyung-ho, he has mentioned through the media that the taxes on financial investment income should be suspended. So he explained that the capital gains tax should be deferred for 2 years, and the current stock transaction tax should be reduced so that more funds can be flow into the stock market. Well, this comes as a new President Yoon. He had previously promised to reduce capital gains tax to support individual investors. So Mr. Yoon has to complete this revision of the tax law this year in order to fulfill his promise, right? But if his administration failed to make the revision in time, then from 2023 January, the investors who have such such capital gains income from the transfer of shares, then they have to they will be taxed on the gains. And so we will see what is going to happen later this year. Well, on the next slide, we will find out the gains from how the gains from the virtual assets, such as like cryptocurrency, is taxed in Korea. Well, before we look at the timeline, it's not very surprising to hear that lots of young Korean investors, especially like 20s and 30s, they have made already huge amount of investment on cryptocurrency in the past few years. So I could have read a lot of news articles related to this topic, right? But so Korea has been one of the hot cryptocurrency market. So in line with that, in March 2020, the South Korean National Assembly passed the new legislation that paved the way for the regulation and legalization of cryptocurrencies and also the crypto exchanges. Well, in terms of taxation, the previous Mr. Moon Jae-in administration, they announced that the gains from the virtual assets should be taxed from October 2021. But then later, the taxation was postponed to be taxed from January 1st, 2022. And again, during last year, this has been suspended one more year. And as of today, the gains from the virtual assets will be taxed from January 1st, 2023. However, as I already mentioned earlier, the current administration is also to revise this relevant regulation as well. I think there will be some delay in taxation on this gain as well. But let's have a look at what the current regulation about this. So starting from January 1st, 2023, 20% tax shall be imposed on capital gains from for the cryptocurrency, which is exceeding 2.5 million Korean won. And the gains are classified as other income, and this other income is part of the annual income tax return. So the individual must file an annual income tax return by May 31st of the following year. However, again, as I mentioned earlier, it is very likely that there will be a delay in taxation on the gains from the cryptocurrency. So we will see what happens next, what's going to happen during this year. Well, on the next slide, let me explain on the foreign financial accounts report in relation to the virtual assets. So as Min-Soo explained that if you are staying in Korea for more than 5 years, and if you have more than 500 million Korean won as a balance of total foreign financial accounts, then you are required to file the foreign financial accounts report. And next year, when we are filing for the tax year 2022, you need to include your virtual assets, the cryptocurrency account for your foreign financial account reporting, the tax year 2022. And the deadline is by June 30th, 2023, as it is not a part of the annual income tax return. It is 1 month later than the deadline of the annual income tax return. Well, on the next slide, when I prepared this presentation slide, it was in February and early March. So at the time, these two candidates publicly announced a lot of promises that they will accomplish if they were elected as a president. And now the election is over, and we have Mr. Yoon as a new president. And I want to show you that both candidates were planning to adopt crypto-friendly measures in terms of taxation. So they both wanted that South Korea's crypto market is to be another further boom. Well, they both promised to increase tax-free amount from 2.5 million to 50 million, which is huge. So we will see. So all right, let's find out whether the new administration will keep their this promise this year. Okay, the next topic is about the tax treatment of remote work in Korea. Well, during the pandemic, many global companies have allowed their employees work remotely from home or from another countries. And as many countries are recovering gradually from the pandemic, so going back to office to work is one of the hot issue for lots of companies, and also their employees as well, and to me as well too. So regarding this, many global companies have adopted a kind of new way of working, and Korean companies have also started allowing their employees work from home. But as Korea is a quite small country and there is no taxation issue, even though you are working from Busan or Jeju Island, so there will be a compliance issue. Maybe, for example, in the United States, if you work remotely from different state, then there will be some compliance issue, right? So when we see any tax treatment of remote work case in Korea, then we are looking at international remote work case. So I would like to go through the following two cases that I have been asked quite often from my clients for your easy understanding. Well, before I explain on this, let me explain about the tax treaty exemption first. So in general, if a foreign national working is intending to enter Korea and work for a short period of time, if he stays in Korea less than 6 months, 183 days, and all of his income is paid by his home entity, not by any of the Korean entity, then this individual will not be taxable in Korea, and he will be exempted from the tax treaty exemption. However, we have a very unique one more conditions to be met to be exempted on the tax treaty between Korea and US, which is the 3,000 income threshold. So even though the individual from US staying in Korea and earning more than 3,000 for work in Korea, then he has to file the return in Korea, even though they are staying less than 6 months. So let's have a look at the first case. Well, this guy, he has worked since March 1st, and he will stay for another month in Korea, and he's been working for his US company and no relation to any of the Korean entity. So he said his 1 month salary is about 2,000, which is under 3,000. And does he have any filing requirement in Korea? And the answer is yes. No, sorry. He is not required to file a Korean annual tax return to report his Korean source income as a remote worker. So according to the tax treaty between Korea and US, and as I said, he can be exempted to report his Korean source income about 2,000 USD. And let's look at the second case. So unlikely from the first case, this individual, she earning about 15,000 USD for work in Korea. So she's been working in since January 2022, and she will be stay until April. So she is working for a US company, and also she has no relation to any of the Korean entity. And does she have any filing requirement in Korea? So the answer is yes, and she has to file the Korean annual tax return to report her 15,000 USD Korean source income as a remote worker. And so according to the tax treaty, also, again, as I explained, that 3,000 threshold, she does not meet this condition. So yeah. And I know that many of the global companies are thinking to allowing people work remotely, but they also have to see if there is any tax compliance issue. And as I said, we have very unique condition for 3,000 for between Korea and US tax treaty. So you have to be a bit careful to be fully compliant for all of you to make sure that all of your employees working in Korea as a remote work to be compliant, and you have to consider these tax treaty conditions. Okay. So today's last topic is about the immigration policy update related to COVID-19. As I said, well, Korea is now currently recovering from the pandemic gradually, and we don't have to wear the the mask outside, right? And I'm really good to hear that, though. So let's see what's happening in relation to the immigration. Well, there are three issues that I would like to share with you. The first one is the quarantine exemption. Well, previously, the overseas traveler who are coming to Korea, they were subject to mandatory quarantine period. But now, if they are fully vaccinated before they come to Korea and by the approved vaccines, then they can be exempt from the 7 days of mandatory quarantine. So which is good, and I think lots of business travelers they can come to Korea without any restriction of the period of quarantine period. The second is a re-entry permit. So the foreign national working in Korea already, and if they have a plan to visit their home country for business travel, or visiting their family members in their home country, then they have to apply the re-entry permit before their departure. But now the Korean government allowed the foreign national not to apply the re-entry permit for every travel. So depending on the type of the visa, so if you have a D-type visa, then the re-entry permit exemption valid for 1 year from the departure. And the last topic is about KETA. So KETA is an electronic travel authorization system, which was introduced since September 2021. Well, this is granting permission, travel permission to foreign nationals of 102 visa-free countries. They can enter Korea without a visa. However, their activities in Korea is limited to non-profit activities. So if they want to work for a Korean company or doing some not like a non-profit activities in Korea, then they have to apply for the proper work permit, like a C-type visa for short visitor, and the D-type visa for the long-term work duration. So, well, this is the end of my presentation, and so thank you for your time. But then I will hand over to Henny for Q&A section and also the closing.
Great, Hyeok. Thank you, and thank you, Min-Soo. Thank you for the really wonderful presentations. A lot of good information and a lot of great insights. So thank you. So let's move on to Q&A. I received a couple of questions. Let me start with the first one. The first question relates to the foreign financial account reporting, and the question is related to what's included within the scope of foreign financial account reporting when determining that 500 million Korean won threshold. The question is, does it include unvested shares? For example, RSU, or also they're asking about foreign retirement pension account, for example, 401k. So I don't know who wants to answer that question.
Yeah, I'm the right person to answer the question. Yes, it's a great question, because actually we have seen such cases of whether they have to file the foreign financial account reporting in the similar situation. For unvested shares, to I guess 2017, the tax authority issued official interpretation, it's a tax ruling regarding that. So the tax authority said if it is not vested but still held on its foreign account format, it should be reported through the foreign financial account reporting, because even if the share is not released yet, but the restricted unit itself has its financial value, so it should be reported through the foreign financial account. Sometimes I think that it may be the challenging, because I don't have shares. I don't have any right for the shares now, but why do I have to release these as the asset, foreign asset? But the important thing is it should be very careful to report on foreign financial reporting. It is not the paying taxes through the reporting, but just the information declaration. So sometimes it would be somewhat helpful to take a conservative approach to avoid any significant penalty for the issues and challenges. So in that cases, as long as the tax authority already issued a tax ruling and clearly said that it should be reported through the foreign financial account reporting, I think we have to report even if we have unvested shares. But the important thing is a threshold, whether my total threshold is within 500 million Korean won or exceed 500 Korean won. But you have to consider such unvested shares also to determine the threshold of 500 million Korean won. And in case of the retirement pension plan, it was not clear in the past when the foreign financial recording system is newly introduced. And then the Korean tax authority has some revision of the tax law, reflecting some question from the taxpayers. And one of these revision is about the foreign retirement pension plan. So if the foreign retirement pension plan meets some conditions, they cannot be they can be exempt from the reportable account. For example, there is some tax the incentives on the contribution in the home country, or there is some tax defer on interest income. And another condition is the contribution amount does not exceed 1 billion Korean won, something like that. So we have to carefully read the condition prescribed in the tax law. So if you believe your foreign pension account meet the condition for exemption, then you do not have to report it in the foreign financial bank account. Most important thing is you always seek an advice of whether it is not clear, even if you read the relevant article in the tax law. I hope it will be responsive.
Good risk management. And so there's another question that's kind of related to the question I just asked, and it's a little bit more technical. Someone asked, if I have RSUs, and it's a lot of facts here, they vested on April 1st, but not released. Okay, so they vested April 1st, but not released until May 1st. They're asking about what fair market value should I apply? Vest date fair market value or release date fair market value? And this person is trying to figure out what they need to do and what exchange rate should I apply since the RSUs are granted by a US company?
Wow, I think that is a somewhat tricky question, because in most cases, RSU are released at vesting. So, and also the Korean tax authority, the tax ruling mentioned that when it is taxed when RSUs are released at vesting. So in this case, it is somewhat not clear which fair market value should apply. But from the conservative approach, I suggest the fair market value at vesting would be more the reasonable, because according to the general tax rule of the Korean income tax rule, because the Korean income tax rule always think the timing of taxation on whether taxpayer has the right for the share. So if assuming that the taxpayer has the right for the share at vesting, even if the actual share is released thereafter, I think the fair market value should apply on the vesting rather than the releasing date. But for more exact information, I think we have to review the entire share plan, whether there is any reason the releasing date is after the vesting. So 1 month is somewhat it's a long period sometimes. Yeah. And regarding the exchange rate is the standard exchange rate should apply. It is a basic when converting the income in other currency to the Korean won. So the exchange rate, you have to find out the basic exchange rate on the Korean the exchange rate providing the site. Yeah.
Great. Yeah, I think we've got, thanks for that, Minsu. I think we've got time for one more question. Okay, so this question relates to kind of the remote working and taxation implications in Korea. So you mentioned that the income threshold is $3,000 US dollars, pretty low. So when you're determining the Korea source income that you need to report, do the remote workers, I guess the question they're asking is, it's low, the threshold's low, and they're asking if the remote workers actually file the return, and how does the Korean Tax Authority really track these filings? I guess it's a question of being able to detect the situation. It's a tricky question, but
well, as a professional accounting firm, we only can mention that they have to follow the rule, right? And they have to fully comply with the Korean individual tax law. If the law says you have a filing requirement, even though you have only very small amount of income to report. But you can also think about that if the income is more than 3,000, but less than 5,000, and there is no tax due or tax to be paid, in that case, then there is no such risk for not filing. So maybe you can also think that about 5,000 threshold as well. And well, so the tax authority, I believe the tax authority doesn't have that manpower to track all of the individual or all of the business travelers coming to Korea for 1 week or 2 weeks, but having like more than 3,000 as an income for work in Korea. So I can say it's not very highly high risk. There's no such high risk, but still, to be followed and fully compliant by the Korean tax law, they have to file the report.
Yeah, I'll also mention AMCHAM fully encourages everyone to be tax compliant. So thank you. Thank you for answering that question in a politically correct way. So I think we need to wrap things up. Wow. I had tremendous expectations for this session, and I have to tell you guys, it didn't disappoint. On behalf of AMCHAM Korea, and on behalf of the co-chairs of the Taxation Committee and CFO Committee, as well as all the attendees, I'd like to express our sincere appreciation and gratitude to Minsu and Hyeok from Deloitte Anjin. Thank you for taking time out of your busy schedules to put on this webinar. We really appreciate it. It's clear that you guys spent a lot of time and made a lot of effort in preparation, and really valuable insights today. And I think you guys significantly enhanced everyone's awareness on this really important topic. Also, everyone, as I mentioned earlier, we will be circulating a link to the recording of this session. So don't worry if you didn't understand some of it, some of the topics you can go back and review at your leisure. And with that, I would like to bring this program to a close. Thank you, everyone, and we look forward to connecting at the next taxation or CFO committee event. Please have a great day, everyone. Take care. Bye.
Thank you.